Good morning. Thank you for joining our latest BetaShares Academy webinar, Start Investing in ETFs. I'm sure no one would disagree that 2020 has presented unique challenges. So one of the most exciting or interesting things, I should say, has been record numbers of first-time investors entering the market. Whether you're new to investing, new to ETFs, or just after a refresher, we really hope this session today gives you some ideas, a little bit of knowledge, and some information to take you forward as you continue your investment journey. Some important information. Everything that we're sharing today is general in nature. Please do your research, seek advice, and read the PDFs before making an investment decision. Some housekeeping. A recording of the session will be sent via email today. You can also ask questions throughout the session. We'll try and get to as many as possible at the end. So please send them through if you have anything that you'd like to know that we don't cover. The BetaShares website contains a lot of useful information that we'll be going into in a little bit further information today. You can also sign up for our regular insights, our weekly newsletter, and economic update from our chief economist, David Bassanese, which is sent out on a Monday morning to set you up for the week. You can also stay up to date with the latest information by following us on our social channels. I'm Sarah Hare, and I'm delighted to introduce my colleague Alistair Mills.
Hello everyone, thank you for joining.
Alistair, before we get started on the session today, can you just share a little bit about BetaShares and perhaps a recap on why ETFs are so important at the moment?
Absolutely. So thank you everyone for joining. Before we start, a little recap on BetaShares for those who are aware, or some of the newer investors who are joining us. BetaShares is an Australian and managed fund manager. We specialise in exchange traded funds, which have the widest range of ETFs on the Australian market and manage over $12 billion in assets under management. Our focus has really been around the Australian investor and enhancing the experience and the number of opportunities for those Australian investors. Some of your more eagle-eyed viewers would have seen 2 new launches in the product suite as well, which we're pleased to announce. 2 of our most popular exposures are now available in currency hedged form. The BetaShares Nasdaq 100, or NDQ, is now available currency hedged through the ticker HNDQ, and the BetaShares Global Sustainability Leaders ETF FE is available currency hedged through HETH. Just looking at the ETF market a little bit more broadly, and this is quite a good example, just looking at total trading volumes. And this applies to Australia and the global market, but we have seen record amounts of participation through this year, the first half of this year, centered around that COVID crisis. If you look at this chart, which shows monthly trading volume, you can see that it was already on a rapidly growing upward trajectory, and we saw record volumes at the end of last year. The COVID crisis actually saw that volumes triple, far beyond anything we've ever seen before. A lot of investors seeking the liquidity of ETFs, the transparency, the low costs available, but just the sheer breadth of options that are available meant that investors could express their views a lot more easily. Volumes have come down slightly as investors have got more set in their positions, but we're still way above trend at the moment, and a lot more people coming to market for the first time, as many of you may be. So,
and maybe, sorry, now it's a good time just to sort of see who is participating today. And what we'd love to sort of see is, are you already investing? So we know a lot of people have started investing for the first time this year, but are you investing already? Are you not investing in ETFs, but you're investing in shares or other listed products, or you're just still sitting on the sidelines, you're not investing yet? So if you'd like to vote, just so we can see, this is good. What I might do, I'll just share that so you can see, which is great to see. A lot of people already investing and already investing in ETFs. Just a few people who are yet to join the ETF party.
Excellent. Well, hopefully this should help people start that journey, but also, yeah, some experienced investors, whether they're looking at setting up portfolios for other members in their family or just expanding their investment horizons, this should provide some pretty useful information across that.
Okay, and before we do get into the main part of the session, let's just have a quick recap on what is an ETF for people who may not be as familiar.
Yep, so an ETF is pretty much what it says in the name. They are regulated just like other unlisted funds. They're in a trust structure. They are open-ended vehicles bought and sold on the exchange. So they typically trade around fair value, unlike something like an LIC or an LIT. ETFs have typically been very low-cost vehicles tracking an index, and with that tend to be passive and very low cost and transparent. But the wealth of options has grown significantly, and there are more and more active exposures coming to market through active ETF form. They span, and this has really been the driver of growth in the ETF industry here in Australia, but they span across such a vast array of asset classes, thematics, regions, sectors, really enhancing the exposure that investors can get to what were quite difficult to access markets, whether it was fixed income or commodities, are now really easily accessible at a low cost on the Australian market.
Thanks, Alistair. Good quick recap there. So now just to focus on the topic at hand, if we can just bring it back to what are some things that people need to think about as they're getting started?
Yeah, look, when you're first looking to get started, it can be quite intimidating. There is a lot of information out there. Your key thing, and you can often end up spending more time thinking about the reasons not to invest than it takes when you're ready and actually making your investment selections. So the key here is there are some cons that you have, and probably the key one is typically when you're starting out, your investment balance, so your cash balance, isn't enormous. You may have a low understanding of what you're doing and a low time allocation that you can put towards this, and just knowing where the right information is. So hopefully we can help with that third point. But you do have some really strong pros that many other investors don't have, and this all centers around time. When you're starting out, you typically have the longest time frame compared to most other investors, and with time comes a really huge benefit of compounding, but also the longer your time horizon, the less impact short-term volatility has, and it enables you to go further up the risk-reward spectrum because you have a longer time to wear this volatility. So you actually have some really positive components to being a new starter. To give you some tips on what you should be looking for when you're first getting started, really seek as much portfolio exposure as you can when you're starting out, and invest regularly. This will mean that and start as early as you can. So give yourself as long time horizon as you possibly can, and this will enhance the growth of your wealth over time. Regular investment means that you'll end up buying highs and lows, smoothing your overall portfolio returns. And like I said, don't worry about short-term volatility quite as much if you have a long-term horizon. Diversification is your best form of risk management. And here you can see a quote from Ray Dalio, probably the most influential investor out there at the moment, or one of, and he really says that when you're building a portfolio, you should have a mix of asset allocation or asset classes assuming you don't know what the future holds, because not everything goes up at the same time. Some things may go down unexpectedly. So diversifying across a broad range can really enhance your risk-adjusted returns there. A few examples of areas you want to diversify across different asset classes. So it stems from growth and defensive, but in terms of equities and bonds, so bonds have had a tendency to rally when equities have sold off. But even within your same exposures, Australian versus international equities, for instance, they can be composed of different sectors and different stocks which may perform differently in different environments. So diversifying across these three layers means that you're likely to get the most enhanced risk-adjusted returns. When you're looking at diversification, I'd say the key is there are three key pillars you can look at. The first is your asset allocation. So that would be a split between growth, defensive, equities, bonds, cash, commodities. So the second layer may be diversification across regions and sectors. So make sure you're not just exposed to the same countries and same sectors within there. And then the third layer would be looking at your actual security diversification. So holding a basket of equities rather than just picking one stock can improve diversification. And this is where ETFs have really come into play and made that very, very straightforward for investors.
That's really good to know. But one of the most common questions, or something that most investors want answered, especially when you're starting out, okay, that's all great, but what should I actually buy?
Yeah, that is the million-dollar question. And look, we can't tell you exactly what you should be buying in terms of different funds and securities. But if you want that kind of information, I would say speak to a financial advisor. They can take into account your personal circumstances and objectives, really tailor a portfolio to you. But from a high level, when you are building your portfolio, the key thing is to build diverse asset allocation in the most efficient way you can. So gain exposure to all of these different asset classes, build yourself a really strong base, but do that efficiently, and don't necessarily, the more trades you make, the more brokerage you pay. So if you can get exposure to a broad theme in an efficient manner, it will set you up in the best way possible, and you can build a really robust core with just a few ETF trades. Again, the key to knowing how your asset allocation might look or how your portfolio might look comes down to your investment time frame and your risk tolerance. Someone starting out with a very long time frame is going to have a higher risk tolerance because they can wear that volatility, probably a higher allocation to growth stocks and riskier assets for that risk return premium. They're likely to invest more in growth stocks and care less about dividend yield sometimes, because they may be on a salary and more interested in growing their wealth pool rather than providing and paying their bills from the income. As your time frame shortens, so this doesn't just have to be retirement, but you could be saving for a house deposit, for instance. The risks to losing capital become a lot more dangerous. If you have an objective on the horizon, the risk of large market drawdowns like we saw in February and March can have a bigger hit to your plans there. So typically, the shorter your investment horizon, the higher your allocation to defensive assets, things like cash and government bonds, for instance. And this will evolve over time. And on the next slide, sort of painted out 5 typical risk profiles, and this gives investors a nice, easy example of how these different portfolios might look from an asset class perspective, just split by growth and defensive. You can see conservative with the lowest time horizon, least risk appetite, much higher allocation to defensive, working all the way to high growth with the longest time frame, biggest allocation to growth, but still some defensive assets in there because they don't necessarily take away from long-term return, but they can smooth out those outcomes.
So with, I think you have to ask yourself a lot of questions and know what your objectives and outcomes are as you start. But let's just go to some of the things that people should be thinking about when they're comparing different funds or different investments and researching where they can actually go to find out this information.
Yeah, so once you're ready and you've sort of worked out your asset allocation mix, and you can start looking at some security selection, there are a few key areas you want to be looking for, and these are available in a multitude of sources, but the ETF website is very good. The first one is that asset class. Make sure what you're buying fits in that bucket of your portfolio. Then you can start looking at your country and sector splits, what's under the hood. The actual portfolio holdings are typically fully transparent on an ETF, and you can see the number of holdings that are there. Like, costs can be really important, and don't just look at the management fee, but look at on-market spreads, look at your total cost of ownership. The distribution yield and franking may be applicable to you. That information is available, as well as the liquidity of the underlying exposure is really key. So like I said, different indices can really have quite a different makeup, and this is an example just splitting between the US market, just here represented by the NASDAQ 100, and the Australian market by the ASX 200. And if you work your way down that first column, you can see a breakup of sectors there. The NASDAQ 100 has a big overweight to consumer discretionary, information technology, and communication services, which actually have a very small representation in the Australian market. Australia, on the other hand, has a very big overweight to financials and materials. Both of those have a 0% weighting in the NASDAQ 100. So two equity indices across different regions can provide very different performance outcomes. The fact is, if you blend these two together, you can diversify really nicely across these sectors and get a really good blend across a variety of different industries. Back onto the fee conversation, and this is just an example on this next slide, comparing two identical before fee exposures. So just taking an annualized return of 5% before fees. The grey line here is represented using a fee of our A200 ETF, so the lowest cost Australian equity ETF on the market, and that costs you 0.07% per year. If you compare that to an average Australian actively managed fund with a fee of 1.55%, you can see the difference this can have on your net of fee returns over the long run. So the key here is make sure you know what fees you're paying, and make sure you're getting after fee value, not just paying more for something that does very similar or gives you very similar results, and that will eat into your return and really has a negative effect on that compounding effect I mentioned before.
So when you are researching options, with most things nowadays, it starts by jumping on the internet and visiting a number of sites. Now, I mentioned our own website, or the fund manager website, has comprehensive fund information. We have a lot of educational content, FAQs, insights, portfolio construction ideas. The online broker that you use, if you use an online broker, they can also have a lot of information and research on companies. A great website is the asx.com.au. That's Australia's exchange, the largest exchange. They have pricing information, they have research, they also have plenty of educational content that across all different asset classes. So that's a great place to go and inform yourself. The government site moneysmart.com is also a good one, and very much covers the financial literacy breadth. So a lot of things about reducing debt, budgeting, but there's also some really great tools and calculators and areas that you can look to build your or grow your wealth. So that's definitely a website that you should visit as you start your investing journey.
Outside of those, there are a number of different news websites, but also some really, really good dedicated independent ETF websites that I'd recommend having a look at. They give you news updates, fund updates, and may even provide some investment ideas there. So have a look online.
No shortage of information online. So just very quickly looking at our own website, and Alistair will take us through the fund pages and what sort of information can be found there. But just at a very top level, when you do get to our homepage, you'll see that the top navigation has about us. So that's just a little bit about the company and who we are, which is always good to know if you're investing with someone. Our education and insight section has a huge amount of information. Our insights is our weekly content. We have economic insight, we have portfolio construction ideas, and content from our chief economist, David Bassanese, who many of you may be familiar with, but also across the team, portfolio managers. Alistair often contributes to that too, so definitely worth checking out. A really important section, which we'll go into a little bit in a little bit more detail, is the investor section. So this is really important, and it includes information about your BetaShares investment. It has distribution timetables, some further additional FAQs for investors, and there's also information about setting up your account with our unit registrar. So we'll talk a little bit about that further on. So let's just jump into the fund page. Is where you're going to look for your investment options.
So if you've landed on our website and you're interested in exploring a bit more into some individual exposures, the first place you want to do is hover your mouse over that Our Funds tab, which is at the top. What that will do is bring up this orange drop-down box, and from there you can see all of our funds are categorized by their asset class or thematic, with the number of exposures that are in each section there. So if you were going to click on Australian equities, for instance, that would bring you through to the list of 16 Australian equity exposures. If you know exactly what you're looking for, you can use this search bar and start typing in the fund name or the fund ticker, and that will click on that, and that will direct you to the fund page. Or if you're liking to just compare every fund in our product range, and like I said, there are 64 of them, you can click on this Compare Funds tab, which is on the top right there in that blue box. So different ways you can access fund pages, but this is your starting point. Once you are on a fund page, and taking the NASDAQ 100 ETF here, NDQ, as an example, the first thing, and it's obvious, start at the top. You've got the fund name, which tends to give quite a good clue into what the exposure is, but beneath that you can see an overview of the fund, and slightly further down the fund objectives as well. The key area here is that orange banner just below the fund name, and this is a number of tabs that you can click on, which will fast track you down the page. You can either scroll yourself or click on those. Some examples: distribution, that will give you dividend and historical distribution information, and announcements, and that has all of the ASX announcements applicable to this individual fund here. So if you work your way down to the key facts of the page, this bit's really useful because this also includes some of the trading information on the fund. You can see the net asset value of NDQ here on the right hand side, and that's based on the closing values of all of the underlying holdings. So that can be a day or two old because of when the US market closes in this instance. On the left-hand side, you can see the last traded price and the bid and offer prices, so the prices you can buy and sell the ETF at the moment. This is really useful for checking your on-market spreads to make sure that those are nice and tight, and often you'll see an INAV. So for Australian equity ETFs, there's an INAV, an indicative net asset value. This is an estimate of the fair value of the fund based on the underlying holdings, and you can use this to check that the last traded price or the bid and offer are sitting nice and close to that. As you scroll down a bit, and like I said, this bit's really important when you're comparing investments. You can see the top holdings here, but you can click on a link that takes you to the download a CSV file, and this is an Excel file of every single holding in the portfolio, which is often available for our ETFs. You can also see a regional breakdown and a sector breakdown below in a nice pie chart form. If you click on download fact sheet on the left-hand side, and this is available in resources as well, this summarizes all of this information in a really nice, easy manner. Working down right to the bottom, as I mentioned, resources, and this is one of the most important sections on any fund page. You can access the fact sheet. We have brochures which tend to have a case for the underlying investment, but one of the most important documents is the PDS, or the product disclosure statement. This is the legal document that will tell you everything about the fund and its exposure. You must read this before making any kind of investment to make sure you fully understand how it operates and what kind of exposure you are getting.
Really important. It may be last on the page, but it is certainly not least. The fact sheets are updated monthly, so you can actually get a snapshot of that latest performance on a monthly basis, summarized, but a lot of the information that you were talking about is updated daily.
Absolutely, yes.
Yeah. Okay, so just changing gears a little bit, we've gone through sort of how to research, how to compare investment options. So let's just talk about let's think about some construction ideas, portfolio construction ideas.
So just looking at your core buckets, and like we said before, so you have these key 4 core buckets that you might look at as an Australian investor. The first being Australian equities as an obvious one, but you might have some global equities in there, some cash and some fixed income. And these are just 4 easy examples of asset allocation pillars you can have within your portfolio. Below, we've included a few example ETF tickers that might suit those. So for Australian equities, A200, which we discussed briefly before, is our broad Australian equities ETF. QLTY is our global quality leaders, so a diversified basket across several international regions. Cash, we have AAA, and in fixed income, here is BNDS, a diversified bond exposure in partnership with Legg Mason and Western Asset. I've also included a few ESG related exposures here as well, that as this grows in prominence, it's important to be aware that you can actually build robust portfolios in line with your responsible investment beliefs as well. So there are 3 examples here which would also be useful when you're trying to find exposures for these parts of your portfolio you can do in line with ESG principles there.
Mm-hmm. And those Australian and global equities that you've spoken about really are those broad market big ETFs. So what happens when, as your portfolio grows, how do you continue building a portfolio once you've got your core in place?
Yeah, so like I said, starting out the core is just the most important, should be front and center of your focus, and just get your efficient diversified exposure to those key pillars. As your wealth grows, as your interest might grow in investments, as you have more time to spend on it, you can start pulling a few more levers and making a slightly more personalized portfolio. Start looking for some outperformance potentially against broader markets. And we call these satellites around your core. And these can be made up of a whole raft of different exposures. For example, you could use high conviction active managers to take a view. You could hold some individual stocks, or you can use some more targeted ETFs. For instance, you could use your Australian technology ETF ATEC if you thought that the Australian technology segment was somewhere that had a lot of growth potential, and rather than taking the risks of picking individual stocks, trying to choose the next Afterpay, you can buy a diversified basket across the Australian technology segment and still look to provide some outperformance versus just the Australian market. The key when you are making these sorts of tilts, and there's quite a lot on this page, and everyone will receive a copy of this presentation to look at during their own time, but this is to give you a bit of an idea of how you can make some of these tilts in line with what your expectations are for future markets, rather than just shooting from the hip. And it's really just split into 2 key expectations. So you've got growth expectations, whether they're rising or falling on the vertical axis there, up and down, or inflation expectations, if they're rising or falling. And that gives you a bit of a grid as to what your future expectations might be. For example, in the top right, if you've got the ultimate scenario of growth expectations and inflation expectations rising, that's really good for your value, really good for your cyclical exposures such as emerging markets and Japanese equities, which have high levels of manufacturing and exporting to really leverage off the global economic growth story. On the flip side, looking at the bottom left, in a scenario similar to what we had through February and March, where inflation expectations were subdued and growth expectations have been falling, you tend to see your real safe havens outperform. So your government bonds, cash, US dollars. So you might make some more safe haven tactical tilts if your view was that this is the likely scenario. And then top left is more what we've seen over the last 10 years. So low inflation expectations, but potential more growth on the horizon has been really good for high quality technology and ESG type exposures. And finally, at the bottom right, if you've got growth expectations falling but inflation rising, gold, miners and property can be really beneficial to tilting there. So this is to give you an idea of some of the more tactical ideas you can make in line with expectations. If you'd like a bit more information on what our views on the likely scenarios are, I highly recommend reading some of our content from David Bassanese. Tune into his quarterly update webinars. He can give a really good overview on which way we think things could be going or where we're sat currently.
And just you mentioned quite a few times going through those two slides, diversification, and those tilts or themes that you were talking about covered by ETFs. So it really is good to see that ETFs providing access to every corner of that market.
Absolutely.
So once you are ready to invest, you've done your research, you've read the PDS, you're ready to go. What happens next?
So the simplest way you can gain exposure, speak to a financial advisor. This can be a broker or a financial planner. They can help you build a really robust portfolio. But if you'd like to do it yourself, it's actually very, very straightforward to get started investing with ETFs. All you need is a brokerage account. There are a vast array of different brokerage platforms out there, different ones. There are cheap ones, more expensive ones which link into your online and mobile banking. Different people have different preferences. It's very competitive there. When you have that set up, actually investing, you just need to use the ticker of the ETF. This is usually 3 or 4 letters, just like an individual stock. Your minimum investment is 1 unit in the fund there. But many of these brokerage platforms have minimum investment sizes. When you are looking to trade, look at the bid offer price, look at an INAV if it's there, make sure you're getting best execution. But some top tips in terms of execution would be avoid the match, so from 10 o'clock to 10:10 and around 4 o'clock. Also, use a limit order. Rather than taking a market order and taking out everything on screen, set the price that you think is fair and use a limit order. That is absolutely key when getting ready to invest there.
Mm-hmm. So once your trade has settled, you'll receive 2 letters. One letter will be from Link Market Services. Now, Link Market Services are the registrar for all BetaShares funds. This letter will contain important information about your account, and it also includes details on how to set up your online account. So information or investment notifications are sent electronically. So it is really important to jump online and set up your account with Link Market Services. You'll need the issuer name, BetaShares. You'll need your HIN, which is a holder identification number, and that's issued by your online broker, and also your postcode. So very easy, very simple to do. And then you'll be able to set up your communication preferences and also find out some other fund information.
Absolutely, and it's really worthwhile jumping on there. You can see your annual tax statements. One important thing, you can set up the dividend reinvestment program for each fund if you wish to reinvest those dividends automatically, and this will save you paying brokerage and reinvesting it yourself through your platform. This is done by the fund at that level. So if you're specifically looking for growth, a dividend reinvestment program is well worth setting up at times.
Mm-hmm. And the second letter you will receive is your CHESS holding statement. Now, this is sent monthly and has information about the opening and closing fund investment balances. So just as we come to the end of the session today, we always finish with this slide because it's always important to keep in mind, but I think this feels especially applicable today. So we've spoken about the information research, but also when you are investing, keep in mind of investment risk. So markets can go down as well as up. There are currency risk, international investment risk, but also some things to consider as you put your money into the market. Everything that we have shared is general information only, and again, there are no research, no guarantees, and if something has done well in the past, it may not mean that it's going to do well in the future.
Absolutely, and that last point, research, so key when making your investments. Hopefully, this has given you a bit of an easier idea of how you can go about doing some of that research. But I mentioned it before, the product disclosure statement for every fund is essential reading if you are considering making an investment there.
Okay, so I think we've got a little bit of time for some questions. So thank you. If you have got any questions that you would like us to answer, I will ask you to bear with us because there seems to be quite a number of questions. So here's a really good one, and I think it almost comes up in every BetaShares Academy webinar. We've certainly got some information on it, but Alistair, can you take us through the fees? You did speak about fees a little bit, and it's something to be conscious of. So how are fees taken out of ETFs?
Absolutely. So management fees associated with exchange traded funds or ETFs, you don't have to pay a subscription fee, or you're not paying a regular fee that you have to sign up to. Fees are automatically taken out of any performance or distributions. So it will naturally come out of the fund, and any performance you see on an ETF or unit price movements is net of fee movement. So for A200, for instance, if you put in $10,000, $7 would have automatically been taken out of that performance over the course of the year on a daily basis. So if you divided 7 by 365, that would be the cost each day, and that is automatically smoothed through there. So you don't have to worry about signing up for fees. It's all automatically taken out that way.
Quite a few questions on currency hedging. So when people invest in international funds, what should they be thinking about currency hedging? And then you mentioned that we have just launched 3 currency hedged products. So a little bit about that, please.
Look, currency hedging, so actually has an extension of the name, and you'll see that a fund is called currency hedged. What that actually does is takes away the inherent currency exposure that you're getting. So if you invest in the NASDAQ 100, as an Australian, you are getting exposure to US dollar movements as well in an unhedged exposure. So if the US dollar strengthens against the Aussie and all else is equal, that will be a net benefit to that investment. But if the US dollar weakens, that can be a net detriment to you as an Australian investor, because your investment is now worth less in US dollar terms. So a currency hedged exposure looks to remove as much of this currency risk as possible and give you a purer exposure to the underlying equities. So you can think of it more like investing in the NASDAQ 100 as a US investor would do. And people do this for different reasons. Some people will blend a hedged and unhedged exposure just to mitigate that volatility from the currency as well. Some exposures can really benefit from currency hedging. Gold and gold miners is a good example at the moment, where when you tend to see strong rallies in gold prices and gold miners, you see the Australian dollar rally against the US dollar. So currency exposure can work in your favor in those environments. So some underlying exposures can benefit from currency hedging, but a lot of the time it is just taking away another source of risk, which is currency risk, which is inherently built into any unhedged foreign exposure.
Thank you. So there was, and we do apologise for talking in acronyms, and we will direct you to some explainer content in the follow-up emails. But one of the questions was, what does consumer services mean in the sector breakdown of NDQ? So you had consumer staples, consumer services, information technology. So they tend to be sectors within the market, and companies are classified within those.
Yeah, but I believe that section was communication services. So
okay.
You are looking at sort of telecommunication areas in that way. So that was a reclassification from your industry sectors there. So communication services.
Okay, and just the difference between a dividend reinvestment plan, so a full or a partial. So what does that actually mean?
So when you go on to Link Market Services, you can choose whether you reinvest none of your dividends, or whether you reinvest all of those dividends automatically, or you can choose to reinvest half of them. If something was yielding 10% per annum and you only wanted a 5% yield, you could reinvest half of those automatically, and it would do that for you. So you can be really flexible with how you want to alter your distribution statements there, or distribution amounts.
So are ETFs suitable for SMSFs?
Absolutely. All of them in our range are SMSF suitable there. So it enables you within your own portfolio and your own self-managed super fund to be really flexible here and gain exposure to a whole raft of different things.
So is there a minimum or maximum amount of time that you can hold an ETF?
No, so it depends on your objectives, and ETFs have the benefit of being extremely liquid. They're traded throughout the Australian trading day, and there are market makers to provide liquidity there for you, even if it looks like people aren't always trading. Like I said, your time horizon tends to come in line with your risk appetite. If you're building robust asset allocation, typically you're looking at a decent investment time frame, whereas there are some other funds which are more suited to more frequent trading. For instance, some of the leveraged short funds may be better for shorter time horizons, but you can hold an ETF for as little or as long as you want. When you make the purchase, its settlement is in two days following that purchase. So T+2 is the liquidity on that front.
Okay, there's quite a lot of economic questions, or questions probably more suitable to our colleague David Bassanese. I will just like to share with you that our next quarterly economic update is coming up on the 13th of August. So just in a couple of weeks, I'll be sitting down with David and we'll be going through his quarterly economic update. He provides basically a current snapshot of what's going on, and there is certainly a lot going on. And then he also goes into an outlook for the next quarter. So just another quick question, Alistair, if you'd like. So how safe is my investment? For example, this one's from Craig, in the unlikely event that BetaShares had financial difficulties, how is my investment protected?
Absolutely. So the vast majority of ETFs out there are physically backed by the underlying stocks, but across the board, they are registered unit trusts. So just like an unlisted active fund, they are regulated in the same way. So your assets are held on trustee account by a custodian and a ring-fenced third-party account in the name of the fund. So they're not accessible by BetaShares. They are completely ring-fenced there and protected from those sorts of defaults. So the highest form of regulation on that standpoint, as opposed to a structured product, which some people confuse them for.
Another quick one, do ETFs pay dividends or distributions quarterly, half yearly or annually?
Now, the frequency of distributions on a fund will vary. Now, that information is available on the fund page in that distribution section, but some will pay monthly. So our cash and fixed income exposures tend to pay monthly, whereas some of the international exposures may only pay on an annual basis. So this really varies from a fund by fund basis. The fund will receive the dividends from the underlying exposure and franking credits, if applicable, and pass these on to investors. And that frequency of distribution can be seen on our website. One thing I will say is at the end of the financial year, because they are registered unit trusts, they will pay their capital gains if there are any there as well. So all of them will distribute around the end of financial year if there is something to distribute.
Okay, thank you. We have just had so many questions come in and we are over time, but I thank you very much for joining us today. As you exit the session, there will be a really short survey, and if you do have any further questions or you have some ideas for some other sessions that we can run, please let us know. Just due to the demand and great questions that we've had through, we really look to run another session like this. It seems that a lot of people have appreciated the back to basics style and starting from the beginning as people become more interested and start investing with ETFs. So thank you very much for joining us. Alistair, thank you so much for your time today.
Thank you, Sarah, and thank you everyone for coming along.
Thanks a lot.